Please come on up.
Thank you, Richard. Good afternoon, everybody. And first of all, I've got to work out how this thing works. Sorry, slight technical glitch.
Yes, it's a bit new yet, so let's give them
Anyway, while we're getting things started up, I just would like to give a brief intro to what I'm going to talk about. It's a very brief overview of the Philippine real estate market, which has been very dynamic over the last few years and very, very topical. So we're going to look at a few of the hot sectors: office, residential. I'll touch on retail and tourism, and then talk a little bit about the bubble. A lot of people are talking about this so-called bubble. What is it, and is it going to happen? And then what makes the Philippines a good place to invest in real estate? Why are people looking to invest here? And then a brief conclusion. There we go. So we'll start with the office outlook, because that's the most active sector, and it's the sector that we at Jones Lang are most involved with. There's a map of all of the CBDs in Metro Manila. From about 12 years ago, there were two prominent CBDs, Makati and Ortigas. We now have about 38 in total, 38 established and emerging CBDs across the metropolis, covering approximately 2,500 hectares of land. So a lot has happened in the last 12 years in terms of our perception of CBD and emerging business districts. And I think these have really come about because of the pressure on real estate in the principal areas of Makati, Ortigas, and then more recently Fort Bonifacio. As companies, particularly the BPO companies that are large space users, as they expand, they need to look for the most competitively priced real estate. And they also need to go to those areas where there's a plentiful supply of labor. So this has caused these 38 emerging districts to come together, and there'll probably be some more later on. That's a snapshot, perhaps a little bit confusing, but that's a snapshot of the office supply versus the pre-commitments. And they're quite big numbers there. You can see that there's about 4.5 million square meters of supply, office supply, from 2009, which is just post-global financial crisis, up until 2018. And then looking forward from 2015 up to 2018, the pipeline supply, which is illustrated in green or yellow, whatever color that is. Now, the blue horizontal line shows the average annual take-up. So you can see that in the 2009 up to 2013, the take-up was at about 100,000, 300,000 rather, square meters per annum. And it's now, the blue line on the right, the horizontal blue line, is now showing an increased annual take-up of about 450,000 per square meter. So while the future pipeline supply looks pretty big, it is being matched by the increasing demand. So by 2020 or post-2020, we don't see a particular oversupply situation arising. As you can see there, a vacancy rate of 4% across all Metro Manila districts is a pretty historical all-time low. It's a very, very low vacancy rate. And you can see there those rectangular boxes and square boxes basically show you the amount of office space in those areas. So Makati is the biggest with about 1.2 million square meters. And Ortigas and Bonifacio come a close second with about 900,000 square meters of space each. The other districts, well, Quezon City is catching up, about 650,000 square meters. Last year was the record leasing transactions, 497,000 square meters throughout the whole year. Now, 60% of that was actual leasing commitments, and 40% was what we call pre-commitments, where somebody signed an agreement to lease for a building that would be handed over sometime in the future. And the reason these pre-commitments became popular is that a few end users in the past got caught out. They thought they'd leave their commitment until the building was ready, only to find that somebody pips them to the post. So last year we found that quite a few locators were actually willing to sign up to something that would be delivered 18 months or 2 years hence. So the 40% pre-commitment is quite a significant landmark there. Location-wise, you can see on the left, Bonifacio Global City had the most activity, about 37%, followed by Makati and Ortigas, or Makati 13%, Ortigas at 21%. And then in terms of industry, it was principally BPO, 72% rather BPO, split between the captives, 31%, and the vendors, the third-party service providers, at 41%. So as you can see there, the office sector is clearly dominated by the BPO industry. Historical and forecasted rents. On the left is 1997, where rents in Makati peaked at about 1,000 pesos per square meter, and that was immediately before the Asian financial crisis, which when it hit caused a very long, protracted downturn in rents until about 2003, and then the market started to pick up. And interestingly, 2003 was about the time that the BPOs started to locate here. Obviously, there were a lot of large, high-quality buildings in Makati that were largely vacant at that time, so they were able to take up space at very, very competitive rents. I know that in Enterprise Center, around about that time, space was taken at 400 pesos per square meter. So if you consider that with the 1,200 pesos that's being asked today, it's a significant discount. So then rents from 2003, as the BPOs took up this space, rents climbed steadily and peaked in the first quarter of 2008. Again in Makati at about 1,200 pesos per square meter. And then they find that the global crisis hit and there was a very rapid downturn. But it only lasted about a year or so here. And by 2010, things were on the up again. And I think it's fair to say that where we are today, rents are more or less equal and in some instances higher than they were immediately prior to the global financial crisis. And the trend is continuing upwards over the next 4 or 5 years. Not at a dramatic increase, but at a steady increase, perhaps at 4-5% per annum, something like that. And we anticipate that will continue for the next 4 or 5 years. Average office rental rates, you can see this is from December 2013 to December 2014. And in Makati, the prime office rents went up about 14%. Grade A rents went up about 22%. Bonifacio only 1%. That's probably a factor of the large supply that's there at the moment. And then further down the list, you can see Quezon City, which became very popular last year. Rents rose by about 30%. Now turning to residential. We're looking here at condominium units, not houses. and we're looking at what we call the mid-range to high end. So that's really condominium units valued at about 2 million pesos and above. So the mid-range goes from about 2 million to 10 million, and then above 10 million is what we refer to as high end. So these statistics just apply to condos. So you can see 204,000 approximately units completed from 95 to 2014. And as we project forward from this year up to 2020, another 145,000 units planned. But the good thing is that real estate loans only constitute about 19% of the bank's total loan. The BSP, the central bank, actually puts a limit at 20%, and it's below that limit at the moment. And that 20% relates to all real estate related loans, whether it's from developers or individuals. So that's quite a healthy position to be in. The completion of residential condominiums, I referred to the 204,000, which are is the column on the left side. And the main areas you can see are the Ortigas, Quezon City, Makati, and Bonifacio Global City. And then going forward from 2015 up to 2020, apart from this year, which shows about 60,000 plus units being completed, it tails off quite dramatically. So a lot of people have been saying, well, there's far too much being built. In reality, those numbers are have in fact been moderated. And I think by 2013, a lot of developers decided to cut back a little bit on the progress of these developments, which means that by 2016, 17 and 18, there will be far fewer units actually coming to the market. And by 2020, you can see it's about 30,000 units. So, about 3,000 units. So it's actually quite a diminishing amount. The share per district of these mid-range to high-end condominiums, you can see that from 1995 up to date, the Quezon City has the majority at about 23%, followed by Makati, and then Ortigas, Pasig, and Mandaluyong. And going forward from 2015 to 2020, it's a very similar picture actually, with Ortigas, Pasig, Mandaluyong, Makati, Quezon City, and Bonifacio really having the lion's share. So another 145,000 units over the next 5 years. Now I'll touch quickly on retail, because it has a big impact on the economy generally. Metro Manila, the column on the extreme left, has obviously got the largest amount of retail space, 7.8 million square meters existing, with 350,000 square meters of future supply. And all the other boxes are Northern Luzon, Central Luzon, Southern, Western Visayas, Central Visayas, etc., show the amount of developments that are there and planned. So the total nationwide supply of retail malls is 14.6 million square meters, with a future supply of 1.4 million. And interestingly, on the left, you can see that 53% of the existing malls are actually in Metro Manila, only 47% in the provinces. But going forward, you can see that 74% of the new developments will be in the provincial locations, as opposed to only 250,000 square meters planned in Metro Manila. So in the provinces, you have companies like SM and Ayala and Double Dragon looking at these provincial locations and building up the amount of retail space, making it a little bit more widely spread over the country. Tourism, those are the countries on the left column which represent the largest number of tourists. And you can see that South Korea still retains its position as the largest source of tourist arrivals, followed by the USA. I think last year, or for the previous 2 years, Japan came in at number 3, and interestingly, China has now overtaken Japan. And I think we can see the number of tourists coming from China to probably increase over the next few years, particularly with the development of Entertainment City and the people arriving there. 4.8 million tourist arrivals last year, which I think was a little bit lower than the Department of Tourism expectations, and they're certainly hoping to ramp that up to about 10 million in the next 3 or 4 years. But obviously to do that, we'll need a lot of investment in infrastructure. We need a few more airports and some more roads and bridges before we get to that magical number. Hotel pipeline. You can see some very large hotels from this year onwards, Shangri-La and the Hyatt at Fort Bonifacio, but also a lot more hotels planned for Manila Bay and the entertainment district. I think we currently have about 16,000 hotel rooms in Metro Manila, recognized hotel rooms with actually a star rating. We have nearly 11,000 hotel rooms in the pipeline over the next 4 or 5 years. So that represents something like a 70% increase in the number of hotel rooms over the next few years, which is quite a dramatic increase. The bubble. Everybody's talking about the bubble. People have different views on whether we're entering into a bubble, whether we're already there, or balance. And the last point there, the intervention of the central bank, which has played a very key role in curtailing excessive exposure of banks to real estate. As I mentioned earlier, there's a 20% limit, which is there's certainly within that at the moment. So we don't have a massive exposure of real estate at the present time. What makes the Philippines an attractive destination for foreign investors? Well, one of the key things, of course, is human resources. We've got a population of about 100 million. In 2011-12, there were 360,000 plus college graduates in the various sectors. You can see, look, engineering technology over 54,000, business economics nearly 52,000. IT related, nearly 47,000. So this is really what makes locators interested in the Philippines, the fact that there's a plentiful, educated labour supply. And a cost-effective labour pool. If you look at the entry level, this is a study in the BPO sector and annual compensation per annum. It's actually in US dollars. So entry level, 5,300 and a bit US dollars per annum, rising to 36,000 or nearly 37,000 for senior manager level. But if you compare that to labor costs in the US, it's roughly about 25%. So this is one of the key factors that labor is still very affordable here. And a comparison of real estate. The Philippines is on the left. The average cost is $194 per square meter per annum. Now, if you compare that with Hong Kong, it's about roughly an eighth of what it would cost you to rent an office in Hong Kong. It's roughly a fifth of what it would cost you in Singapore, half of what it would cost you in Sydney, and 16% lower than the nearest rival within Southeast Asia, which is Malaysia. So the real estate represents a very good offer for locators. But that's all the plus points, so it paints a pretty rosy picture, but what dissuades investors from investing? There are still, unfortunately, a couple of roadblocks that are still there. First of all, ownership restrictions, that's quite a significant factor. Foreigners cannot purchase more than, well, they can't purchase land, period, and they can't own more than 40% in businesses. So a foreign land-owning company can only hold 40% of the shares. If you're looking at leasehold, you can only get a 25-year lease with an option to renew for another 25 years. Unfortunately, you can't get a 50-year straight lease unless you're in a special economic zone that has its own charter, like Clark or Subic, where you can get a 50-year lease straight. But outside of those special areas, you're limited to 25 plus 25 years, which does have a significant effect on investor sentiment. And the ease of doing business. I think we've improved a lot in the country over the years. I think we've gone up several notches, and I know that there used to be about 16 things that needed to be completed before you could start a company here. And I believe that's now down to about 8. So significant inroads have been made there, but it still takes about 31 days from scratch to actually getting your company established. So that's quite a long time. When you compare it to Singapore, which I'm told takes 2 days, and Australia, which if you're lucky, you can get it all done in 1 day, which seems miraculous to me, but that's what people say. So whilst there have been improvements, there's still some way to go there. So wrapping up in conclusion, we feel that there isn't an imminent bubble, and that the residential sector, which was the area which most people are seemingly concerned about, is under control. The economic indicators for the Philippines remain sound, with continuing prospects for growth. And the property demand drivers, which are the overseas remittances, which continue to grow, BPO revenue, which was at about $15 billion last year, and revenue from tourism, which is beginning to pick up. These are all forecast to grow over the next few years, and this will fuel further growth in the property sector. So ending on a high note, an optimistic note, we feel that certainly the property sector has a good few years to run yet. And just finally, well, I think most people here will know who we are and what we do, but I think we, in terms of transactions in the office sector last year, we covered about 60% market share in Grade A office leasing. And in Bonifacio itself, for Bonifacio, we transacted about 92% of the space. Another area where we've grown dramatically is the landlord representation, where we have, last year we secured 25 new sole agency appointments for commercial buildings. So Richard alluded to signboards earlier. I think you're going to see a few more in the future. And that's it. Thank you very much.